Hey traders, welcome to another global macro update. In this video, we're going to be looking at the Japanese asset price bubble and how we can look at how central banks and how governments reacted and tried to take initiative during this difficult time when it did pop, and how we could possibly see the Fed act and where the markets could go, because obviously there are, in my opinion, two different pathways that people see. For the bull side, it is the economy is terrible, but the Fed is able to hold up the stock market until COVID passes over, and then things will get back to normal. The stock market will come back up, and then we'll reach all-time highs, maybe not this year, but next year, and the Fed will save us, is the sentiment for the bulls. For the bears, obviously, economy is bad. Fed can't save us. They can print as much money as they want, but the value of these corporations are diminishing because of A, oil, B, COVID. There's just a huge myriad of difficult situations that companies are facing all around the world, which is in turn very bearish, which would obviously cause investors and traders to look for exposure on the downside, or at least hedge. So there are two options right now, and we're going to look over what happened to Japan to try to understand what central banks can and can't do and how much of an impact they actually have when things go south. So let's read here. The Japanese asset price bubble, what you can call a bubble economy, was an economic bubble in Japan from 1986 to 1991 in which real estate and stock market prices were greatly inflated. The bubble was characterized by rapid acceleration of asset prices and overheated economic activity, as well as uncontrolled money supply and credit expansion. Now, doesn't that sound familiar? Uncontrolled money supply, credit expansion? That does sound familiar to what we're seeing right now in the United States. More specifically, overconfidence and speculation regarding asset and stock prices were closely associated with excessive monetary easing policy at the time. What are we seeing right now? Excessive monetary easing policy, that's for sure. Overconfidence and speculation regarding assets and stock market prices, I would definitely say that we have some of that within the United States, so it is looking pretty similar. So we can see in the section below, the bursting of the Japanese asset price bubble contributed to what many call the lost decade. Japan's annual land price averages nationwide have finally risen since the asset bubble collapsed. So it's taken this long, through only a mildly 0.1% at process that's taken 26 years to show up statistically. So they've been in a deflationary spiral, I guess you can say, for a while, meaning that the price of stocks, the price of real estate is not able to go up. Unlike what you've seen in more American, Western stock markets and real estate prices, they have gone up exponentially, but because of this deflationary spiral that they're in, they're unable to curb deflation and create any sort of inflation, meaning they can't get prices of goods and services and asset prices to increase. Now, this just shows you how much meddling they did. So initially, this is the easing of the credit, basically, to find cheap money. We can see that in 1986, it was the official discount rate, so the federal funds rate, I guess, in Japan, would be around 5%, and they dropped it from 5% in 1986 to 2.5% in 1987. So really, in a very short amount of time, they cut it in half, which back then was a very substantial amount. But while you're actually trying to understand this and watch this, try to take into account how much more aggressive the United States have been taking in terms of the fiscal and monetary measures that they have been taking on to try to fight '08 as well as now. And then after they cut it substantially, they then raised it, and that was one of the potential reasons why it did crash. But we see that there's huge central bank meddling, and this is a part of the reason. They cut interest rates to really allow a lot of easy borrowing for businesses, for individuals, and then they quickly raise them. So you're kind of screwing over people who were trying to make use of the cheaper money, so then you're, in my opinion, this kind of meddling is going to have some sort of repercussions. And we can see a more extensive description there. And I just want to go down a little bit further and look at the money, supply, and credit. So the growth of credit was more conspicuous than the money supply. During the bubble period, banks were increasing borrowing activity and at the same time also financing from capital markets substantially increased against the backdrop of the progress of financial deregulation and the increase of stock prices. The money supply continued to increase even after the Bank of Japan tightened its monetary policy and reached a peak in 1990, thereafter continuing to mark still double-digit growth until the fourth quarter. So even if you are cutting the money printing from central banks, traditional banks, can still create money out of thin air through credit, right? So if I owe you money, there's now value created out of thin air. And banks do this all the time when they're loaning money out for mortgages, for businesses to start up, whatever they're loaning out money for. They only need a certain percentage of the money they loan out. It's not like they loan out, the full $100 that you put into the bank or $100K or whatever it is amount of money. But, fractional reserve banking creates money out of thin air, just in terms of credit. Money supply and credit dropped sharply by 1991 as banks lending began to drop due to a shift in bank lending attitude. In my opinion, we're starting to see this now, where banks are having more restrictions for how many people they lend to. They have restrictions for the quality of the actual the person who's getting the funds. So they're just making more regulations, so it's harder to lend. So we're already seeing this tightening for lending through the banks. And the last thing we want to touch on is all the way down here, government spending. During the first few years after the bubble crisis, Japan experienced a sharp decline in the GDP growth rate. In 1993, the Japanese government decided on a major increase in government spending. It was aimed to increase domestic demand and stimulate consumption to help pull the economy from recession. This is exactly what we're doing now within the U.S. economy. However, increasing government spending did not turn as effective as the government predicted to be. This is the big questions that we're going to have here. Is this Fed central bank printing going to be enough to save the stock market? We know the economy is not doing great. We have COVID, which is complete lockdown, and we have oil prices, which is a huge aspect of America and Canada. And both are detrimental to the overall economics of both countries. So then let's continue on here. And we're printing money right now to try to try to save the economy, which is basically government spending. And in Japan's case, it did not turn as effective as the government predicted to be. Now, reminder, in 2008, a lot of people think we got out of the 2008 financial crisis, and yes, we did to some degree. It did help, but we had massive quantitative easing measures, 3 huge implementations of QE in the United States, and artificially low interest rates for I don't know how many years exactly. I believe it was 6 or 7 years. Interest rates were basically artificially set to almost zero, and we had 3 massive implementations of QE. So it's similar to what we're seeing in Japan. It is considered that consumer confidence was the lowest from uncertainty in the future after the bubble crisis, and consumers prefer to save rather than spending in such a situation. This is the key point that I want to drive home. Governments will try to spend, will try to print, try to expand the budget deficit in order to implement QE in order to try to stimulate the economy. That's all they can do. They can give individuals money, they can give corporations money, they can lower taxes, but they can't physically make you, a consumer, a individual living in their nation, to spend money. They can't force you, hey, buy more good services, buy more things that you don't need but want. They can't make you do that. It's up to you, the individual, to say, do I want to save and wait for a rainy day, or do I want to go out and spend to be a consumer, buy more than I really need? And that creates more stimulus in the economy when you're buying more goods, when you're being more of a consumer. It just makes sense. But with huge difficulties in economic times, you're going to have an entire generation, entire demographic kind of get a negative outlook on the future, and they're going to save. They're going to be a huge section of savers because they know how hard it is to not have money. They know how hard it is to try to start a business. It fails because of COVID. It fails because oil is just completely destroyed and you had an oil company or you had some sort of company and stock, you're going to be very conservative for your view in the future. So you're not going to spend as much, you're going to conserve, you're going to save, and that is deflationary by nature. And this is the big question that I want to point out for today. So let's look further into some of the stuff here. Actually, before we get into the actual deflationary point, let's actually look at the chart, what happened during this time. So now we're going to look at the actual bubble burst of the Japanese asset price bubble, and let's look at our trading view chart. So this was from February 1984 for the Nikkei 225, which is the index for the stock market in Japan. And we saw from 84, we saw massive price appreciation, huge boom in the stock market, which is great, right? You saw a bit of difficulty in 87, so did the American stock market, but it kind of went on in its merry way. Excuse me. And then we saw a huge liftoff, and what are we looking for? We're looking for the same structure that we are implementing right now in the present day that we saw in 2008, we saw in 2001, we saw in 1930s. The structure of bear markets, I can't say is the same because it's not, but the way you view the market structure and the way you approach any bear market should be repeatable. It should be dependable and repeatable. And that is what we're looking for, is our view of the market, our way of trading bear markets needs to be dependable when we are looking at these bubble bursts, not even in the United States, but in different economies around the globe, when things have happened, when economies are running too hot, when they have too much cheap money and too much cheap credit, and they burst. And this is just one of those times. We see America have a similar situation. And this is very similar, in my opinion, to what we see right now. All right, so let's take everything off and let's just first talk about the approach that we want to have with the market when we are looking at bearish moves. First thing, we need to understand fibs. We have a swing high and a swing low. We are looking to attach the top swing high at the swing high, which is right here or right here. You can kind of argue because this is a recent high, but this is the all-time high. Back test for yourself. I'm not going to tell you exactly which one. I'm personally going at the top right here, but just back test which one you think is better. I like to do all-time high, and then you're looking for a major swing low, which in my opinion is right here, because after you see that push, you're not seeing any series of higher highs and higher lows from this initial push to the downside, and you're seeing major breaks in key levels of supports. That's going to be your P1. That's a push one that you're seeing. That's your initial momentum starter for the bear market. You don't need to enter this because this is the initiation. Now what you're looking for is your C1, your correction one, because at the end of the day, we're not looking for a P1 entry. We're looking for the start of the P2, which is right here, P2. So this is C1, meaning correction one. P2 is push two. You get a correction 2, which is a second correction, and then you get a P3, which is the push 3. So you get 3 pushes and 2 corrections in terms of how I personally like to view the markets in bear market territory. In massive economic shifts, not just a little bump due to it's hard to know obviously when you're in it, but this situation is important as 2008, 2001, 1930s, the asset price bubble in Japan. The current COVID situation is as great as those economic situations, in my personal view. So I'm treating it as such. So we're looking for the pullback, and this is what we saw. We saw a series of higher highs and higher lows, and then in our 2 corrections, C1 and C2, we're looking for a 61.8 to 50% retracement to find our key level of supply. That is the structure that we are using to trade within these bear markets. So we're not going to enter short until we have a swing high and a swing low, and we see a series of higher highs and higher lows, push the price up to around 50 to 61.8 to the all-time high or the swing high that you're looking at. What do we see right here? So let's take everything off and let's look what we saw right here. So this is the swing high, this is the swing low, and Let's just try not make it difficult at all and make it as simple as possible. We got our first P1 right here, massive move to the downside. We're now looking for our correction one, and then we see an anchor point right here, which is a low. We see 1, 2, 3, 4, 5 touches of this ascending trend line. That's a pretty well-respected ascending trend line if you were to ask me. And we also see 1, 2, 3, 4, 5. So we see 5 touches of the support, 5 touches of the resistance. Yes, it is extremely skinny. If you are looking at a smaller time frame, it'll look better of a ascending channel, which is a bit of a flag. But in my opinion, that is respected for a continuation pattern to the downside. So we see the price continue higher and higher and higher until we get right at the 50% fib level. At this area, we are looking for failure from the bulls. We're looking for weakness from the buyers. What do we see after? We see a break, we see a pullback, validating the previous high, as well as the previous support as a new level of resistance. We initially get a bearish engulfing candle for the initial move to the downside. We test a nearby support, and then we hold. And then this is, in my opinion, where you're going to get a lot of indecision from, the finance puppets of the world, I guess, just talking ahead saying, is it bullish? Is it bearish? We don't know. We don't know what's happening. Economic situation is bad, but stock markets aren't doing too bad. We get these lulls here, but once you start to see the momentum start to shift back down to the low, I think that is when you will start to see that capitulation kind of huge sell-off. And we'll talk about the current price action a little bit later on. But what you're seeing is this move from downtrend to consolidation to uptrend to consolidation. And once you start to see weakness, not only the ascending zone breaking here, but once you start to see the double top forming, you get our first top right here, and then you get a second top with a huge bearish engulfing candle to initiate that sell-off right here. Then you're like, okay, there's a double top. It hit the 50% fib twice, rejected twice, very aggressively, barely got into the zone. Sellers are definitely present. And then you could be looking for entries short at that point. And once you're able to break our key low right here, creating the double top, in my opinion, that is a high probability situation that we want to be entering. So in terms of market structure, how we would play this in terms of how we're looking at supply zones, how we're looking at entering markets, in my opinion, very good and easy to understand market structure for the first push for the Nikkei 225 index. So the next push, exact same thing we are doing, right? We are now going to look for the swing high and the swing low, draw Fibonacci's. The swing high that we saw was the recent major market high that we used as our supply zone. The next swing low is that huge push we saw before we started to see a series of higher highs and higher lows. You could say, oh, this is the pullback. Not really. Previous support, new resistance. You could say that it is a break after this support, this resistance, but you see this squeeze right here, and this is going to be this supply zone that we're going to be looking for. So you see a squeeze. The price is not near the 50% or 61.8 fib level, which is going to be within this box right here. So you could be looking for long. Patience is the key, especially during these situations. What do you see after the actual price broke? You see a little test of the 50% fib level. Right here, you see a nice little tight consolidation with the volume accumulation. Don't really see a volume, but you do see a potential double top where you see a high, low, and then you see a lower high, you see a break, retest of the previous support as a new level of resistance. And you also broke that previous squeeze support that you saw back, I guess, way later in 1990. And then once you break this major structural support you see right here, then you start to see the massive sell-off, because that's the last level of confidence that you're seeing. You see a massive push to the downside, a significant rebound. If you actually draw in a fib, that's probably going to be a key zone just above the 61.8. But then you do see that massive sell-off that does push the price all the way to the 272 extension, which is going to be the first take profit that we're looking for. So I did go through it very quickly. If you do want a more detailed breakdown of our structure. I hope it's easy to understand what we're doing, and we'll go over different price action patterns that we saw in 2001, 2008, 1930s in the US stock market. But the fact that we're seeing the same sort of structure appear within Japan during this crisis is, in my opinion, very significant and shows validity and efficacy of our trading system. All right, now let's look at kind of what happened after. So this is the truth about deflation. So Japan, after the bust, they had long-standing deflationary mindset since the late 90s. So widely expected that the BOJ, or Bank of Japan, is unlikely to achieve inflation around 2% stably anytime soon. So what's taking so long for the BOJ to achieve 2% for inflation? Why is it taking so long to go back to what you call a desired state for the economy in terms of the Keynesian economic approach to how to run an economy, right? Inflation is a good thing in their eyes. And because Japan can't get it, they think that Japan's in a really negative spot, which I'm not saying it's not a negative spot, but Keynesians do not like deflation. So why is it taking so long? A well-known structural factor is unfavorable demographics and associated low potential economic growth. So I'm sure a lot of people do know this. Japan's population pyramid is very skewed, meaning we can see in the 1960s, they had, it's the baby boomer generation of Japan basically, where there's a large group of individuals in a certain demographic. We can see in 1960s, a lot of individuals at the bottom, which makes sense because there's more individuals driving demand for less things that they have up top. So, just making sense, trying to wrap everything together. If you're retired, you're going to sell a lot more stuff than if you are at the peak of your economic output when you're in your, let's say, late 30s, early 40s, or 50s, where you're going to not buy as much stuff because you're older, you're not going to drive around as much, you're not going to go and buy a brand new car every year if you're retired because you don't know how long you're going to last in terms of the lifespan, and you don't know what medical expenses. They just have a different way of spending money. So you can see right now it's great because the highest point of demographics is where all the consumption is. You're buying your first car, you're buying your first house, you're buying your first couch, you're buying your first computer, you're buying your first everything when you are young. And then when you have maximum output, it's looking pretty good. But once you have the largest demographic at the end of retirement, kind of like how we're seeing the baby boomer generation right now in the United States, and especially in Japan, they've already gone through a lot of it, you're going to have a very skewed supply and demand shift in the economy, where a lot of the assets are held by older people. Making sense? You've worked longer, you have more money, and you're able to buy larger, more expensive assets like real estate, and you're able to buy more stock. But when you are at the end of your life, you're not really going to be buying more. You're going to be slowly selling off or just holding and incurring the interest. So what we're seeing right now is we initially had a lot of demand due to people buying their first houses, people first getting into stocks. That is huge for inflation because there's a lot of people buying stuff. There's a lot of consumption. There's a lot of desire to purchase. But once that huge demographic shifts to more of the retirement age, they're now no longer buying more real estate. They're just taking in the real estate income for renters, and then if they pass away, you got to sell it, right? Or if you're trying to downsize, there's a downturn in the economy, you're going to sell because you don't want to hold on because you're only going to live 10, 15 more years. You're more inclined to sell, or you're more conservative when you're retired, and that's a problem. So that is creating sell pressure within the economy, just in terms of demographics here. Also, looking at the psychology of the individuals within an economy. This is Japan. That's one of the reasons why they have had difficulty with inflation. Another reason is a lesser known factor is the public's lack of understanding of the 2% target and the strong resistance against price hikes due to upward bias in perceived inflation and inflation expectations. So individuals aren't even in an inflationary environment, and they perceive the future to be inflationary. Their expectations is that prices of goods and services will go up. Contrary to general beliefs held, moreover, households' mindsets are not deflationary. Even though they're not deflationary, since their perceived inflation and long-term inflation expectations are always positive and far exceeds the rate of change in the consumer price index, even in deflationary phase. So this is all about the consumer psychology. Right now, a lot of Americans are still in the consumer psychology. It's not a problem. Things will get back to normal. Prices of goods, assets are going up. That's not a problem. But once you get that shift to occur, where potentially you're going to have a lot of people saving because of uncertainty in the stock market, uncertainty in the economy, a lot of people losing their jobs, that is going to be very deflationary. And in my opinion, central banks will overreact. They'll not only react, but they'll overreact. And we can see right here the outcome from this deflationary period because the government is trying to print and print and print and print. We can see now Bank of Japan's balance sheet now larger than the country's GDP. So Japan have been doing this for a while. We'll get into it very shortly. But yeah, Japan's balance sheet is higher than its entire GDP, which is unbelievable. Japan's central bank has become the first among G7 nations to own assets collectively worth more than the country's entire economy, following half a decade's spending spree designed to accelerate weak price growth. That's unbelievable, is it not? To me, that is absolutely nuts. $4.87 trillion worth of assets in the Bank of Japan holds are worth more than 5 times the world's most valuable company and 25 times the market capitalization of Japan's most valuable company, Toyota. That's unbelievable. Central bank data releases on Tuesday showed how much the BOJ, Bank of Japan, has amassed over the 5.5 years of what's called quantitative and qualitative easing policy. And we can see Bank of Japan's buying spree right here. This yellow line is the nominal GDP. And then we see the Bank of Japan since 2012, we see this chart right here, has just been on a massive buying spree. This is printed money. This is just printed money out of thin air, buying assets, seeing that huge balance sheet go up and up and up in total assets. And we see that same thing here. It's literally been going straight up. But the two things that have been a factor in the lack of inflation, like we talked about, is the demographics and is the consumer and the psychology of the everyday individual living in that country. It's really hard to change. And we've been talking about the velocity of money for a while now, and that's in the United States. I don't really have a chart for Japan, but that is how fast money interchange hands. And we're seeing a decrease in velocity in the United States significantly, which is deflationary in nature. Last thing we're going to be talking about is the diminishing effects of Japan's quantitative easing. This is, in my opinion, the biggest question that is on economists' minds, or maybe more just financial trade or financial navigators, investors. This is the number one question I think that a lot of people are going to be having right now is, will the Fed be able to save the stock market, the economy? Will just printing more and more and more money work exactly like it did in 2008? It helped everyone. There was no problems. We had the best bull market in history because of it. Will it be just 2008 round 2 except with a pandemic into it? Well, let's look into how quantitative easing affected Japan over the long term, because there's no way in hell that we're going to stop quantitative easing and we're just going to go back to how things are normal. This is a new era where cheap money, QE, and UBI, unlimited money printing, modern monetary theory is implemented right now. This is modern monetary theory in my personal view. So let's look at what happened here. BOJ, excuse me, I'm going to get a little bit of coffee and then we'll continue here. All right. Bank of Japan has deployed strict Keynesian policy, including more than 15 years of QE, or buying the private assets to recapitalize businesses and prop up prices. We haven't been doing it for that long. We did it in 2008. We did 3 rounds of QE, quantitative easing, and now we're doing basically QE infinity. But Japan has been doing it for more than 15 years. Despite these efforts, there is strong evidence that Japan's easy money policies only produced an illusionary growth while failing to improve the fundamentals of a stagnant economy. That's a significant statement. The more Japan's leaders tries to stimulate their country's economy, the less it responded. I did listen and read to someone talk about quantitative easing as sort of giving drugs to a drug addict. At the first time, it's a huge kick, huge stimulus, huge high. You're getting, like up in the air, up in the clouds, feeling amazing. But as time goes on, as that drug user uses that drug, he will gain a level of tolerance, and that huge stimulus rush gets lower and lower and lower and lower. The more times you actually use that drug, the less it's going to have effect on you. So you're going to have more. You're going to have 2 hits instead of 1 to feel that same. And then next time you're going to have 3 hits instead of 2 to feel like you had the 2. And it's a never-ending cycle. And, the proper way is to wean off of it. Like a drug addict, weaned off of it. It's going to be difficult, it's going to be tough, it's going to be really shitty for a while, but you end up basically getting healthy over the long term. It's difficult for an economy, but it, in my opinion, can be possible. The other way is just basically to take so much that you overdose and die, which would basically imply that you would have hyperinflation, entirely new monetary system that would need to be in place because the current one would die. So those are your 2 options, basically, in my opinion, that we're going to have here. The money stock in Japan grew by over 10% per year between 1986 and 1990. But in my opinion, that's not much compared to what we're seeing right now. Look at how much money we're printing right now in the United States. It's unbelievable. The discount rate fell from 5% in 1985 to 2.5% in 1987, fueling large-scale borrowing that many Japanese investors used to buy assets in mainland Asia, particularly South Korea. Similar thing that we saw in the United States and what we're seeing right now. We're seeing significant growth in the money stock, and we're seeing significant rate cuts in the federal funds rate or the interest rates. So we're seeing a similar situation where governments, central banks are trying to do everything in the monetary and fiscal policy to stimulate the economy. They're trying to meddle with everything. They want their hands in everything in order to try to help out. But the more they try to help, the less impact it really does have. Japan was effectively in a bubble economy propped up by cheap paper. Does that sound like an economy that you know of in recent times? Because it sure does for me. When recovery proved slow, Japan turned to Keynesian remedies. I think that we will see America do exactly this. If they're not able to see the economy go and boost back up to what they want it to, they're going to try to meddle some more by printing money, lowering interest rates, and increasing the government deficit. A series of rate cuts between 1991 and 95 left the discount rate at 0.5%, just above the zero bound. Fiscal policy was aggressive during the 1990s when Japan attempted 9 stimulus packages during the decade, totaling 140.7 trillion yen, or the equivalent of $1.3 trillion. These measures were unprecedented for a modern industrial power like Japan. Yet, there was still no recovery. They did 9 attempts of stimulus packages during that decline, but there was still no recovery. So, in my opinion, this tells you something. This tells you that the governments will try to do another round of QE, 2, 3, 5, 10, as many as they need to, but like we've seen in Japan during different debt bubble crises, I guess you could say, it doesn't always work. It worked in 2008. We got out of it. We had a great bull run. That's great and fancy and all, but we've seen it not work before, and we've seen it just absolutely demolish the deficit of central banks. And because the current monetary policy makers in central banks in the United States are all Keynesians and are pro modern monetary theory, basically, where they're going to expand the balance sheet, basically print as much money as they need, which is going to debase the US dollar, and they've already put interest rates to zero, so they can't really do anything within the the monetary side, and they are doing everything they can on the fiscal policy side, printing a lot of money. So yeah, I think that we can learn a lot from Japan. I think that there's a lot of similarities that we share within not only the actual price action, but the structure of the cheap debt, or the cheap credit, easy money, and mass speculation. And we see that yet again, the bounce went to the 50% level. It's very, very, very common to see bounces that go up 50% to the swing high. And then we can see that this was, let's say, from the late 90s all the way into the 2011s. This was the deflationary period that we're talking about, where we saw a complete sideways consolidation within the stock market. You didn't really see any higher highs. You saw lower lows, nothing really great to profit off of within the stock market. Yes, it did range, and you could be looking at great price appreciations, but you don't see that strong, I guess you could say, healthy stock market where you're seeing strong higher highs and higher lows. So you're not seeing the highs get broken. So you're not seeing really growth happen. And then what you see is negative interest rates and quantitative easing get implemented in 2013. So this is 2013, the start of 2013. And then we can see that quantitative easing, or quantitative and qualitative easing, and negative interest rates artificially propped up the market. But Japan's just purchasing more assets. It's not like the economy is shifting and there is more economic demand, there's more productivity, there's more people who have higher incomes that they can purchase more consumer goods and services. It's not like that. This is the government printing money and buying assets. There's a big difference between having a healthy economy where there is growing revenues, there is growing income, there is people who have more money in their pockets and are willing to part with it because they feel like they are secure financially, which they can go out to the movies, they could go to a bar, they could go out to a restaurant, spend money on goods and services they don't need but want because they have financial stability. This is what you're looking for I guess a very healthy economy. And you're like, this is very odd because governments are meddling so much within the current system. All central banks, or not all, but a lot of central banks are buying assets and pumping funny money into the system. So, in my opinion, we're seeing a very similar situation that we saw in 2008. We're going to have banks and central banks meddle with as much money or with much things as they can. I'm just trying to get a last thing here, and we will see how it goes. Like we said before, when recovery proved slow, Japan turned to Keynesian economic remedies, printing money, lowering interest rates, and it was still no recovery. So just because they're printing money does not equate to the economy being saved. Don't have much more to add on that. Hopefully you did get quite a bit of information on what happened to Japan, how the actual structure of the market did look when we did have that major move to the downside. Because if we look at the structure we see right here, very similar to what we're seeing right now, very similar to what we saw in 2001, 2008. We're using the exact same structure every single time in bear markets. Even looking at the 1930s, we see that we're using the same structure. This isn't some random thing that we've just thrown on a chart. We've backtested this in different recessions, different periods of times, different economies, different nations, different parts of the globe, and this has proven to be a successful system to use in a bear market. So we are going to speculate that this will be just another one of those, like Ray Dalio says. It's not going to be a brand new system that comes into play where somehow the Federal Reserve is able to print value out of thin air and everything just goes back to normal and, you know, the economy is saved. This is very similar to what we saw in Japan, where there was massive speculation, massive credit, easy money given to people, and very, very low interest rates with fiscal and monetary policy pushing the use of easy money to speculate, basically. And now we're going to get a bust. And we've had it time and time again. And I'm not going to say that it's a guarantee or anything, because nothing in the market is a guarantee. Yes, this could be something brand new where we do see the Fed bring that, you know, stock price all the way back up because they're debasing the US dollar so quickly. But I'm putting money on this. I'm putting my neck out there and putting money on the line that this will go down. And we've tested it back over and over and over again. I don't really have much else to say. That was the overview of Japan and how the debt bubble burst in terms of the first initial breakdown of the chart, where we saw the all-time high. We saw a massive slam down. We're seeing our nice consolidation, creating our continuation pattern, going to at least the 50 or 61.8% supply level before we look for entries to the downside. That is our structure. That is our system that we are implementing for this current market. So not much more to add. I will end off this video. I'll just show off the 1930s and then look at, let's just go replay right here so I don't have to zoom all the way back. And then let's look at what we saw right here. Yet again, high, low, 50%, 61.8. You see a nice, you could call it a wedge, you can call it a channel, and then you do see the price retest that high. But what I'm personally doing is setting my stop loss just above the 618, because we've seen in, for example, 1987, let's actually look at it right now. 1987, Black Monday, 1987, all the way right here. Just, okay, right here. Oh wait, 1980. Oh, it's right here. Okay, never mind. Okay, never mind. Okay, so there it is right here. Sorry, that took a little bit longer. But this is a different recovery. I was scrolling for a little longer there. But this is a different recovery where we saw a massive crash down, a very significant, greatly talked about crash. But you see this very quick recovery, right? You don't see the continuation. So let's do the exact same structure to how we would trade this. Swing high to candle closure, swing low. I would make sure I'd refine the candle closures on the daily and high and low, but we can see, let's just extend this out further. When will I be basically changing my bias, saying, okay, maybe the bottom is in somehow, is going to be break of the 618. Once we see the break the 618, I will shift my bias, because anything can happen in the markets. I can't discount anything from being impossible, especially with, we've seen negative oil prices. I did not think that that was even a possibility, but we've seen it, so anything can happen. And my 618 zone within the S&P, which is, let's say, 2951, is going to be my key level where I'm going to say, man, the market is not looking as weak anymore. Right now, I will do a TA just on the S&P, going over it again tomorrow, because we just went over it. Look at the previous YouTube video we made if you would like an analysis on our view of the market. Very simple. We broke our ascending wedge. We're now in a descending triangle pattern, creating our lower high, squeezing the price towards the apex of the pattern. We are looking for a move to the downside, and that's going to be the initiation of our additional add-on to our trade. We already have exposure to the downside within the SPX, and we're very happy with sitting and patiently waiting until the market does dump, because fundamentals, technicals, all are pointing to the downside in my personal belief. So I'm putting money on it. I'm putting my neck on the line. I've been calling it for a while. I'm saying it's gonna go, and if it doesn't, hey, I am wrong, and people can call me out, but I'm putting my money on the line, and I am willing to take that bet. So thank you very much for watching. I will close this video now, and I'll go over the questions from YouTube and TikTok after I close this recording. So thank you very much for watching. If you do find this informational, educational, entertaining, it would be greatly appreciated if you do subscribe to our channel. We are trying to provide a more different approach in terms of how we're looking at the market, in terms of just small, like 15, 5-minute, 1 minute, just talking about recent news. We're going back decades. We're going back, many, many years, looking at different bubbles that burst, different economic situations that could look similar to ours, because the best way to understand what you can see in the future is by looking in the past. And the further you look in the past, the further you'll likely be able to see in the future. To end it off, everything in life is, almost everything in life is cyclical. There are cycles to almost everything. There are cycles to seasons, credit, markets, your own life, psychology. And the further you look back, the further you will be able to understand human nature, which drives the market. So thank you very much for watching, everyone. We will be continuing with these interesting perspective giving videos, I hope, that they are to you. And until next time, have a good one.